It's now apparent the company's executives still have more to learn. Carvana's fairy tale rise has since turned into a nightmare for investors amid rising interest rates, inflation, and self-inflicted wounds. Carvana has consistently borrowed money to cover its losses in growth initiatives, including an all-cash $2.2 billion acquisition earlier this year of ADESA's U.S. physical auction business from Car Global. Morgan Stanley last week pulled its rating and price target for the stock. Analyst Adam Jonas cited deterioration in the used car market and a volatile funding environment for the change. First, management missteps. Carvana grew exponentially during the coronavirus pandemic, as shoppers shifted to online purchasing rather than visiting a dealership, with the promise of hassle-free selling and purchasing of used vehicles at a customer's home. But Carvana did not have enough vehicles to meet the surge in consumer demand or the facilities and employees to process the vehicles it did have in stock. That led Carvana to purchase ADESA and a record number of vehicles amid sky-high prices as demand slowed amid rising interest rates and recessionary fears. Second, debt. The company's bonds touched all-time lows this week, as it burns cash and faces rising borrowing costs. The Wall Street Journal reported that the company's long-term bonds have declined to distressed levels, with some now trading as low as 33 cents on the dollar. The yield on their 10.25% notes was over 30% as of Tuesday, according to Market Access, a sign that Carvana would struggle to borrow from bond markets presently. Morgan Stanley cited the company's debt and uncertain funding outlook in pulling its rating and price target for the stock. Jonas said, a deterioration in the used car market combined with a volatile interest rate funding environment made for a material risk to the company. Jonas issued a new base case range for Carvana of between $1 per share and $40 per share over the next 12 months. Third, pricing pressures. The used car market is on pace to finish the year down more than 12% from the 40.6 million used vehicles sold in 2021, according to mid-October estimates from Cox Automotive. Carvana's sales through the third quarter of this year were up 4% over 2021, but were far less profitable than a year earlier and were lower on a quarter-over-quarter basis. Carvana's third-quarter sales declined 8% from a year earlier, while profits per vehicle sold plummeted 25% to $3,500. CEO Garcia described the end of the third quarter as the most unaffordable point ever for customers who finance a vehicle purchase. The declines have come amid falling wholesale prices of new vehicles. The Manheim Used Vehicle Value Index, which tracks prices of used vehicles sold at its U.S. wholesale auctions, has fallen by 15.4% this year through October after peaking in January, including a 2.2% decline from September to October. Retail prices traditionally follow changes in wholesale. That's good news for potential car buyers, however not great for companies such as Carvana that purchased the vehicles at record highs and are now trying to sell them at a profit. Used vehicle prices have so far remained steady, but that may not last long, as the wholesale costs continue to decline. And lastly, affordability. Frey noted that vehicle affordability continues to decline, with auto loan rates reaching a 15-year high even though prices declined slightly. The average used listing price for a used vehicle is stabilizing but remains near record highs of more than $28,200, according to Cox Automotive. The competition also is catching up to Carvana. During the coronavirus pandemic, franchised vehicle dealers such as AutoNation were forced to begin selling vehicles online while showrooms shuttered and consumers stayed away from dealerships. Carvana's traditional rivals began delivering on its same promise of hassle-free online car purchasing.